So hello everyone, good evening. Thank you for taking the time to attend this webinar today. My name is Roshan D'Souza and I head the marketing activities at Aasthy. Thank you all again for joining in, and we certainly hope that at the end of this webinar, you'll walk away with some golden nuggets, right? So just to explain the purpose of this webinar to everyone, we kept getting requests by a lot of our users, both online and offline, with a lot of questions about what we do and how we do it. And so as a company, we pride ourselves at being as transparent as possible, right? And hence, this is our attempt to open up the communication gates between us and our users. Okay. So before we start this webinar, I would like to point out that the total duration of this webinar will be for 45 minutes. And we reserve the last 15 minutes for a question and answer session from the participants of the webinar, right? So there are some very basic rules of the room, and I request all the attendees to follow these rules. First of all, requesting all the attendees to be on mute. I mean, I have enabled everyone to be on mute by default. But if someone else is talking at the end during the question and answer session, I request everybody else to be on mute so that everyone can hear each other. Like I said earlier, we'll have a Q&A at the end, so you can ask your questions during that session, or if you have any questions, you can post them in the chat box. The chat box is open for questions. And some of the questions that you may already have might be covered by the panelists during this webinar, right? So I request all of you to wait till the panelists are done talking. And if you still have questions, you can ask them. And we also have a few questions that have already come in from our support staff and from social media and things like that, right? So we'll try to cover that as well during the end. So moving on, I'm sure the panelists will cover Aasthy in a lot more detail, but let me just quickly share a small brief about what we do at Aasthy. So just to give you a brief introduction, Aasthy is a new age fintech platform. We are here to democratize real estate investments, and we are making real estate investments a lot more accessible to everyone in the country by being pocket friendly. You can start investing in prime real estate assets from as low as 5,000 rupees. And the entire process from sign up to investments can be completed in 5 minutes. So that's a small brief about what Aasthy is up to. But to give you a lot more detail, we have our panelists who will speak about Aasthy in a lot more detail as well. So Aasthy is being piloted by some of the most brilliant minds in the game, and who are our panelists today as well. First is Srinath, who is the founder of the company. Unfortunately, Narayan Lal could not attend this webinar due to some personal reasons, but we have the other co-founder, Mr. Nimit Kothari. So I request all the panelists to just give a small brief introduction about themselves, and then we can proceed with the webinar. That's all right.
Sure. Hey, thanks, Roshan, for that introduction to this webinar. Hey, everyone. Hope you're having a great day and continue to have a great day thereafter. So I'm Srinath. I come from rich data, technology, and social internet background. I've handled petabytes of data on a daily basis, and I've handled large internet applications like PUBG Mobile, one that stays on top of everyone's mind. And one of the reasons behind me starting Aasthy in the way it is looking at how less retail participation is in an asset class like real estate in India. So digging deeper, figured out that there are a lot of gaps in terms of transparency, data, digitization, all of that. So that's where I come in, and I'll just pass that baton on to Nimit. Why don't you introduce yourself as well?
Hey, Srinath, thanks a lot. Hey, everyone. My name is Nimit Kothari. I'm a co-founder at Aasthy. I have been a seasoned wealth manager for almost a decade. I have seen the industry closely at a 360-degree level and have worked in various capacities with organizations such as Anand Rathi, HDFC Private Banking, IDBI, IMC. So throughout this period, my focus has always been on providing high risk adjusted returns to our clients and keeping clients first. And that's what we do here at Aasthy. So yeah, thanks. Quickly, I'll speak about Narayan also. He's not here. So Narayan has a decade of experience in investment banking, and then he has another decade of experience in real estate sector. Narayan takes care of the supply side in Aasthy. So yeah. Roshan, you're on mute.
I'm sorry. Thank you, Nimit. Thank you, Srinath, for that introduction. So moving on, let's start with the topic of discussion, right? So which is a most common thought that a lot of people have about us is, why should you consider real estate as an investment asset class, and what are the different investment opportunities with Aasthy? I think the best person to answer this question is definitely Nimit Kothari. So Nimit, if you can share your point of view on this, that will be great.
Sure, Roshan. So real estate has been one of the most traditional and most common form of investments since ages. Especially we Indians have had an affinity towards this tangible sector from a long time. We all would have heard stories, in terms of how valuation on this asset class has increased exponentially over the years. However, due to several inherent features and risks that come along with real estate, we believe it makes much more sense to own a real estate in form of fractional real estate or alternative investment class. Now, as the name suggests, fractional ownership is a mechanism wherein many investors come together, form a group, they pool the money and invest in a property, be it residential or a commercial one. The most important characteristic here is that the risk of an investor gets diversified significantly, and one can hold on to multiple such properties, thus making a portfolio for them. We all know that asset allocation plays a key role in determining one's overall portfolio return. And we firmly believe that, depending upon one's risk perception, their objectives and investment tenure, one should look to allocate 10% to 30% of their portfolio in fractional real estate. So yeah, that would be more or less about fractional real estate.
Okay, thank you. Thank you for that, Nimit. So one of the other questions that we usually get is, how, with all these things, how does Aasthy come into the picture, right? And what is it that we are doing, and why is it that we are doing this? So since Srinath is the brainchild behind Aasthy, I would like to invite Srinath to take the floor and throw some of his insights into this.
Sure. So just taking a step back, right? Instead of addressing the question directly, just probably want to give some insights on what the current scenario is looking like in terms of how infrastructure in India is, and how people are participating in the same, and what it should look like. So if we look at globally well-developed countries where infrastructure is really good, we see that 35 to 45% of individual wealth goes into real estate, right? And I'm talking about US, Germany, UK, Canada, China included, right? Now, if we look at India, we see that there's only 17%, a little less than 17% of our wealth that goes into real estate, right? And this may be contrary to popular belief, because a lot of us might be thinking that most of our money actually goes into real estate. And the other thing that I want to say is this number has been declining over the last 4-5 years. It was 22% in 2016, and it's already lesser than 17%, right? And this has been predominantly driven by a lot of convenience offered in investing in the equity markets. I'm sure all of you would have heard about the Zerodhas, the Grows, and so many other formats that you can use to invest, right? So essentially that has led to a huge gap in infrastructure development, right? And this gap makes countries like India not a great place to either come into or start a business in, for someone from the outside. Now, you might have heard a lot of people who keep thinking of, starting businesses in Dubai, in US, in Singapore, and all of those places, right? So that's just the current scene, the super high level, like the 60,000 feet view of this. Now, when we look at what is actually causing this problem, right? That's where we look at, there is a huge need for data, access, and transparency, right? We see that there are a few people who make, the 5x, 10x, 20x investing in real estate, during its early stages, investing in pieces of land or large portions of land. And then there is the massive set of audience who end up making less than 5% returns financially when investing in real estate, right? And that is essentially, breaking down to that data piece, right? If people would think of real estate as a financial investment, then that access to data is today not available, right? I don't know what is a great place to invest, which will fetch me 10%, let's say year over year, putting my money into real estate, right? The next bit is access. Today, if I'm earning my first salary, it's not possible for me to invest in real estate, as a whole. I need to, accrue this money over maybe a couple of decades, even sometimes, to actually go and buy out, a house. And the last but not least, there is very little transparency, right? A lot of us have heard about all kinds of fraud that happens with real estate as well, right? It's very difficult to have access to a lot of this information on, is this ownership valid? Is this the right kind of deal? Is this tenancy going to be valid? All sorts of things, right? So essentially, there was this need for a platform which gave access to data, access to investing with just 5,000 rupees, or even smaller, to be honest, right? Investing with 1,000 rupees, and be doing that in a transparent way. And that's essentially what we're doing, right, with Aasthy. And that's where Aasthy comes in, to be able to give all of these three things. Right now, Aasthy as a platform today already provides data in a summarized format. We do provide real estate indices, we provide heat maps. All of these are today available for free for all users, which also gives information on what is the expected appreciation over the next 1 or 2 years. Is it good? Is it bad? There's like a red, green, yellow indicator on top of all of these things. Then there's also a sense of what is a real estate index, right? How are prices going across different places, right? So that's on the data side. And then the next piece is really these fractional investments. Now, there are fractional real estate investment providers that have been in the game for almost a decade now, right? But this was still not accessible for that common man who would want to do SIPs for 5,000 rupees, 10,000 rupees, maybe even 50,000 rupees, right? So that is the next big thing which Aasthy took up. And today we are offering these investments at a 5,000 rupee ticket size, right? And all of these added with, the right kind of investment structures, we create entities, we digitize this in a way, people get access to these CCDs, people are able to invest in less than 5 minutes. Roshan did mention 5 minutes, but I would want to say like 3 minutes, right? And everything is visible, including market prices, their entire portfolio of investments, the other participants who are investing in that. So that's, in a nutshell, what we're doing. We're essentially democratizing real estate investments.
Okay, perfect. Thank you so much, Srinath, for explaining what we do. And I'm sure all of our participants now have a better idea about Aasthy. And yes, there's a considerable amount of thought that goes into everything that we do, including how we shortlist our assets, and what is the thinking behind it, and the data that we acquire to do these things, right? But on what basis do we shortlist these assets, and what are the risk mitigation framework that is being deployed at Aasthy? Nimit, can you talk about that a little bit?
Sure, Roshan. Before that, let me take everyone through what the output is for everyone. Okay. Before telling everyone how do we shortlist the asset, what is the output, as in what returns they are making right now from our offerings. Okay. So Aasthy right now is offering an alternate of debt product, wherein an investor is able to make close to 13 to 16% return per annum for a duration of 12 to 18 months with a strong and robust risk management system in place. Okay, so this is the output. This is what investor is listening to before getting in investing in Aasthy. Okay. Now, what work happens behind that? Let me take you through that. So first, the underlying collateral is real estate. So how do we go about shortlisting an asset? Okay. So point one, data. Data is the king for us. Data drives the decision making. We have close to 50 million data points as on day, and out of which 7 million data points almost are refreshed on a daily basis. How this data helps us is in deciding what will be the demand absorption in those specific micro markets or clusters after 1 to 2 years. Okay, right now we have a data which the demand prediction model, which gives us an accuracy of 98% based on our backtesting. And since it's only available for 1 to 2 years, and hence we are coming out with offerings in 1 to 2 year period. In a few months, we'll be having data for 5 to 7 year period also, and then we'll have equity offerings also in that time. But right now, the first part is how we use data to see which are the micro markets or clusters where there will be good demand absorption. Now, what do we mean by good demand absorption? It's basically that people would want to move in those areas and want to stay there because it's closer to their workspace, or there's a high growth corridor coming nearby, or for some other reason. Okay, so that is one. Now, once we have identified those micro markets or those clusters, we only go for projects which are nearing completion. Okay, at least 85-90% completed projects. Now, one might ask that if they are already 90% completed, why builder would still want funds from you? Okay, so here we enter as a last resort of last mile funding to them. Okay, where probably banks and other banks and NBFCs won't enter as a last mile funder. So, and the work for which builder needs the funding would be probably because of some of the landscaping work, some of the beautification work around the property, creation of clubhouses, pools, some work related to electricity. And most of these projects, either OCs have been received or OCs are to be received in next 3 to 5 months. Okay, so this gives us a safety net to us and our investors that we are entering into projects in which stake of significant big holders has already gone in. Now, once those micro markets are identified, within them projects with nearing completion have been identified, then we go on to the what kind of builders we are associating with. Okay, we obviously do title due diligence, what kind of builder he is, what kind of projects they are doing otherwise, what is their finance servicing history, and all those factors are taken into account. Lastly, we have two more risk mitigating mechanism here. So one, against the 100 rupee we give to the builder, we have a collateral worth 1.3x to 1.5x, which means against the 100 rupee, I have a collateral worth 130 to 150 rupees in the SPV's name before giving the money to the developer. So that is a safety net for us in case things go south. And we also enter into buyback agreements with these builders that after 1 year, the builders come back to us and take the give us back the money and take the property back. Okay, so this is the asset shortlisting process, and these are the risk mitigating factors which helps us and which gives us a comfort in giving this defined returns to the user.
Perfect. Thank you, Nimit, for explaining that entire process. That goes into the asset shortlisting and the framework around the risk mitigation. But the best part about what we do is how passionate we are about data and about the data accuracy and all that, and we pride ourselves in being a data first company. And also it reflects, right? So if you go into our website, you will see a lot of things about data points and REIs and heat maps and whatnot. So there's a lot of data in play into all this. And so how are we utilizing all this data, right? And since Srinath is our data connoisseur, I think he'll be able to explain that in a lot more detail. So Srinath, could you please take us over with that?
Sure, Roshan. So sometimes what I end up speaking becomes too technical, and I've seen people kind of disengaging. So I'm going to try to put it in a story format, right? So now when we talk about data does not necessarily mean some crazy machine running some algorithms and coming up with some amazing thing which will make someone a billionaire in a day. right? There are a few things which are just basic logic, and that's where we start with, right? Now, if we look at, if we keep talking about absorption and demand prediction, all of that, right? Now, the most important thing is to understand how any sort of demand supply works, right? Now, when we look at real estate, somehow the assumption is a little different. The assumption is if something is going up, then it will continue to go up. I think that is okay for a certain duration, post which it is not, right? So a very simple way to understand demand is for us to look at what a person is ready to pay for that space, to live there or to use that space, right? Now, if we look at some of these numbers, that gives us a huge story, right? If we look at, let's say, rental yields, right? Now, globally, the accepted number is that it should be somewhere around 7 to 8%, so that it can take care of all sorts of maintenance and all of those issues, right? But now when we look at, let's say, really high priced real estate markets in India, and by the way, I'm talking about things in general here, it does not specifically take any assets. There might still be individual assets or projects which are good. But in general, if we look at, let's say, a Mumbai, right, residential rental yields are about 1.5 to 2%. Right? This in comparison to 7%. Now, even if we look at India as a whole, residential rental yields are somewhere around 3.5 to 4%. What that generally means is that people are not willing to pay as much to actually live there. And so some of these prices are inflated, right? So that is a good starting point for us to say, how can data help us in identifying these, right? So when we look at heat maps that are present in Aasthy, this is one of the foremost considerations that we look at, right? What is the demand in a particular area, right? Now, just because something is priced high does not necessarily mean there is high demand, right? There might be a really amazing property, let's say, like a 5-star villa, so to call it, but there might only be 100 people who may need that, quality of 5-star villa. There may not be 10,000 people, right? And that's when we see that the rental yields in those places significantly go down. So now we know that at some point people will stop purchasing, or people will start valuing those properties much lesser. Right. So we've got those heat maps in position in Aasthy. The way we look at that, on a daily basis, like Nimit pointed out, we're continuously refreshing our data. So we get to know what is the demand at a micro cluster level. So these clusters could be at the size of sometimes just 100 meters cross 100 meters, that's small, and sometimes as big as 4 kilometers cross 4 kilometers, right? We do this at a geohash level, where we are not really taking into consideration the name of the locality and all that, so that we can be unbiased to this data, right? For example, those who are in Bangalore would probably understand, like as soon as I bring out names like Indranagar or Kormangla or MG Road, suddenly, there are all these spikes that go in our head, oh, these are all expensive areas, right? But if I have to be unbiased, then I have to look at it like a machine. And that's exactly what we do, right? We look at these data points, we look at these different yields, and then we also look at the historic prices, the last 5 years, 7 years. Now, on top of all of these, we also add a few, sort of manual insights, right? Things that help us understand growth triggers, right? Now, it is common information. Public projects are always common information, which is available on government websites. And, thank God it's India. This information is public. Now, with this, we can figure out how useful a growth trigger is, how different is a metro station compared to a mall, right? How do we look at that? Well, if a metro project is going to be 20,000 crores of investment versus a mall being, like 300 or 400 crores of investment, that is how reliable that piece of information is. A 20,000 crore project is not going to be scrapped within a day or two, right? Versus, let's say, a 200 or a 300 crore project. So these are some manual, sort of like data insight additions that we do by looking at these points. But of course, at some point, at some time, this will be automated. Beyond that, there are other things that we do with our current model, because we do buybacks with builders and developers. We also look at their credit history, whether they've already worked with large banks, what sort of analysis has been done. And also we look at their capital to debt ratio to see, where they are in terms of receiving these funds and how they can pay back in that duration we give. So essentially, these are some of the, sort of buckets of data analysis we do. Without going into it any more technical, I think I'll just stop there, Roshan. I can take specific questions if there is on data.
Okay, perfect. Thank you, Srinath, for those insights. And I hope our participants now have a clarity on how we use data and in order to do what we do and how effectively we do it. We have a lot of questions coming in, so I think we are almost at the end of our discussion. So as we speak, we have an asset live at the moment, and it's our first asset that we have listed from Hyderabad, which is SRI Yadadri Hills on the outskirts of Hyderabad. So Nimit, if you can please share some insights about this asset, then after this we can move on to the question and answer session.
Sure. Before telling about this asset, just as an investor, what all things matter before you go for investment? Okay. In my mind, three things come to me. One is the return, second is the duration, and third is the risk. Okay. So in terms of returns, as of now, since you're offering debt products or alternative to debt products, we are focusing more on 13 to 16% kind of return on a per annum basis. Okay, so that is one. In terms of tenure, right now we are going only for projects between 12 to 18 months. Most of the projects, in fact, are 12 months project. And lastly, the risk. Okay, so what kind of risk are there? I would like to throw some lights on this. So obviously, first, or maybe how we are mitigating those risks which are inherent in real estate. Okay, so one is through data. As I explained, whatever decision making, whatever location is to be decided, it's done by data. We don't, out of 100 projects we receive, we hardly choose 2 to 3 projects to go ahead with, because that's what we are sure about our data, that we will not go for a project unless the data says us to go. Okay, so that is one. Second, projects nearing completion, that further reduces the risk. The title due diligence, the developer due diligence, that reduces when a builder comes back and enters into an arrangement where he buybacks the property, that is another risk mitigating factor. And lastly, we have a collateral close to 1.3x to 1.5x, which helps us in mitigating all these risks. One risk which still remains and which we openly tell to our investors is the delay in project risk. Okay, so this risk remains to a certain extent. Now, obviously, in a very good micro market where there is the projects are nearing completion, there is, and the projects are already 90% completed, OC either received or to be received shortly, the risk of project delay is minimal, but this risk remains, and an investor should be aware of this kind of risk. In terms of all the assets so far, we have done 6 assets and raised close to 6 crores from almost 380 investors. We are now live with our 7th project, and so this is the first time we have moved out of Bangalore. We have moved on to Hyderabad, in fact, in the outskirts of Hyderabad. And this project, it's quite interesting because, as I said, we usually have a collateral of 1.3x to 1.5x. In this project, we have a collateral of 2.5x. So in terms of good risk-adjusted returns, this is one of the best projects we have come up with so far. Okay, I think we are open for questions now.
Okay, perfect. So we have a lot of questions coming in, and we also have to address some questions that had already come in earlier as well. So let's move on to the questions, starting with, just let me open up the questions here. Okay, so one of the questions that came in that often comes in is a really basic one, and which is, what is fractional investment in real estate and how are we different from our competitors in the fractional investment space? So Srinath, can you answer this question?
Yeah, sure. So just to answer what is fractional investment in real estate, right? There's a bunch of info on Google search as well, but at a high level, it is just like, being shareholders of a company, owning fractional pieces of an entity that holds the underlying asset, right? That's just putting it bluntly, right? Now, in terms of differences in, compared to other fractional investments that are available there are quite a few differences with Aasthy, right? But I'll highlight two big ones. I think the most important difference is the ticket size, right? And the participation, being able to participate with 5,000 rupees compared to, most of the other fractional investment players today do anywhere between 10 lakhs to like 35 lakhs, right? Yes, 25 lakhs is still lower compared to, crores of rupees that people had to participate, for fractional investment, like 5-6 years ago. But in the aim of democratizing it, right, everyone should have access. Today we are at 5,000. Hopefully someday, we are able to do it at much lower. The other big differentiating factor is our focus on that last phase capital appreciation, right? So typically there are like 4 stages of capital appreciation in real estate, and post the 4th stage, it's more about the continual returns, the rental yields, right? Currently, we are focused on that 4th stage of capital appreciation, which is just that last bit before an asset is fully usable, for the end user's use, right? And we're able to do that with the help of, our 50 million plus data points with a really high accuracy. And that these two, I think, are the huge differentiating factors, right? Being able to invest with 5,000 and the being part of the capital appreciation rather than a meager rental yield.
Okay. So I just want to point out to all our participants that we'll also be having other webinars as well. This is just not the one and only webinar. So unfortunately, we'll not be able to take all your questions because we already have a bunch of questions that we have to answer. But of course, all your questions are noted and we will respond to all these questions, you individually if possible, or in our other webinars, we can address these questions as well. So moving on to the next questions. This question is from Azim. So he wanted to know what are your plans in the future with Aasthy? So again, I think Srinath would be the right person to answer this.
Sure. I mean, I can talk about like the short term to medium term and probably even give some hints of the long term. So I think in the next few months, right, one of the things which we want to do, we've always been calling our platform, a very transparent platform. It's very social in nature. Like if you go to the platform, you can see who are the other people who invested, we try to share their social handles as well, as long as they've given access to that. And so this way it's a lot more trustworthy, right? So we want to continue on that journey, share more with users, share updates on the status of their investments, these underlying assets itself, right? And also give more data on the risk versus reward option, right? Like why is something going to give, like you see assets with some are like 13 point something percent, some are 14%, some are 15%. Right? What is the reason behind, one being 13 point something percent, or maybe even 12 point something percent? Maybe because that one has the OC received, maybe another project doesn't have OC received. So all of those, sharing that data, I think that's critical for us. We'll continue to start sharing that, in the next few months. Then there's the other thing, which is today we are doing only, fixed return, sort of guaranteed buyback investment options, right? We are also probably looking at, opening it up a little more, being able to pass on that risk reward to the end user, give out that range and, call out something that, hey, you know what, this is probably a 5 to 25% option, or this is, like a 10 to 15% option, but let the users, take that choice and decide to participate whether they want or not, right? I think in a slightly more, let's say, medium to longer term, of course, creating even more distribution in portfolio, we'll try to bring in some commercial options as well. And in the longer term, we'd want all these investments to happen over the blockchain for even better, transaction and ownership controls.
Okay, perfect. So the other question that we have is again from Azim, and also I think this question will also answer one question that we got from our chat from Harnik. The question is, what cities are we looking at in the future? And also, are we looking at anything from Mumbai? I think Nimit, since you're from Mumbai, I think you'll be the perfect person to answer this.
Great. So right now, all our assets which we have completed so far are from Bangalore. Okay, this is the first time we have moved to Hyderabad. So now, okay, so Aasthy is a fintech player. Okay, so it's not important whether we are based out of Bangalore or only in Karnataka. So we will not be restricted only to Bangalore or Karnataka. We can be across any of the cities, tier 1, tier 2, tier 3 cities. Okay, so the plan is that right now we are in Hyderabad also. We'll soon move on to Chennai, Nagpur, Pune to follow. In terms of Bombay, we need to, Srinath can add on further here. But in Bombay, in terms, the premiums are already factored in the valuations to a large level. Okay, so, and you need to understand the vision of Aasthy probably. So we want to give that flavor of capital appreciation to an individual with as less as 5,000 rupees. Okay, now for a capital appreciation in 1 to 2 years, we don't think Bombay is a great place to go as of now. Okay, probably on the outskirts of Bombay, we have seen some areas like such as Boisar or some other areas where we can see some good demand absorption in future. But as of now, we'll be moving to tier 1 and soon to tier 2 cities, starting with Chennai, Nagpur, and Pune.
Okay, perfect. Let me take one question from the chat as well. It's a really good question. I think this is already answered in the webinar, but we'll still take it. So the question is from Mr. Anand Satya. He wants to know, why do builders sell flats to Aasthy for a lower cost at 1 year to buy back? Isn't it easier to just take a bank loan? Srinath, can you answer that?
Sure. For multiple reasons, right? The first reason is, I think, the timing, right? With the access to capital from Aasthy, it's much quicker compared to, a bank loan, right? The second thing is, we are much more closer to real estate in understanding what is the effective utilization of this capital, right? How does this go back into, actually selling those units that the developer is working on? So that way, it becomes a lot more accessible for the builder. Now, again, I'll just add on to what Nimit said, right? The sort of super premium builders already have access to structured capital. They have much better financial planning. They're never going to, participate with Aasthy, right? These are those sort of like not so premium builders. I wouldn't say like tier 2, but maybe in future we will explore tier 2, where they would not have the structured financing option ready-made. If they start today, they would take anywhere between 3 to 6 months. And we are talking about these projects heading completion in the next 3 to 5 months. And even if you stretch it out, in the next 6 to 12 months, right? And in this period, every month is critical, right? So the time and access to capital is really important for these players. Second thing, in terms of their branding and in terms of their history, they do not have that sort of leverage with, big banks, right? Which we compensate with the help of data. If we know that that cluster or the locality has, good demand absorption, then indeed we should support a builder who may not necessarily have that big branding with, the HDFCs or the ICICIs of the world. So yeah, that's the reason, Roshan.
Okay, perfect. Thank you, Srinath. One really good question that we have is from a user online. This question we get asked a lot, but I think this will clear up a lot of doubts for our participants today as well. The question is, what happens if a developer defaults on the payment? Nimit, do you want to take this?
Sure. So when a developer defaults on a payment, okay, let me explain the process, how it works. 100 people come together, investors, and put the money in a SPV. Okay, someone will invest with 5,000 rupees and someone will invest 10 lakhs rupees. Everyone comes and invest in a SPV. Before giving money from this SPV to the builder, we have a registered sale agreement wherein the property comes in the name of SPV. And at the same time, we have a buyback agreement. Now, before giving money to the developer, these two documents are executed, and only then this money is given. So in case of builder default, the company can obviously get into the liquidation process. Obviously, that's not what we want to do ideally, but we have a collateral of 1.3x to 1.5x. So if we have to liquidate, even assuming a 10-15% cost of liquidation, the investors will still make the same IRR what they're making, or maybe in fact few more basis points on their overall investment. As I said, the risk is not of default, but the risk is of maybe a couple of months of delay, which can happen. And in that case, again, the investor will continue to make that IRR, or again, maybe few basis point extra because of the penalty clauses in the buyback agreement.
Okay, perfect. Thank you. Thank you, Nimit. I think that clears up the question of one Mr. Ritesh Mehta as well. So I think that answers Ritesh Mehta's question around the SPVs and how the investors come together. So let me just go on to another very interesting question that we got on the chat. I think Srinath, you can answer this. Let me just put that up real quick. Okay, so how do we know the genuineness of these data points, and what are the valuations on each area, and the sources for the same? And he also wants to know what is the model that is based on for these data points.
Got it. So now there are two ways to look at this, right? One is we look at what is actually the filed value. So I'm going to use a lot of sort of similarities with the stock market, maybe, right? There are values which sometimes people call the book values, and then there are things which are called the market values, right? So we look at both of these, right? Market values we know because on a daily basis, we are scraping the entire internet for any sort of listing that goes live anywhere on the internet, right? Not just listings, even blogs, forums, that just talk about these pieces of information. Since that is not much, the reliability is more on all of these classifieds portals and a lot of things which are out there. So that gives us a sense of what the market is essentially trading at. On the other side, there are guidance values provided by different state governments, which are available on their portals. Like Karnataka has, I don't remember the exact URL, but it's kaveri.something.net, and Telangana has the same thing, Maharashtra has the same thing, right? So now it's a good comparison that we do between the two, right? On one side, there should be enough market data, right? And on the other side, if it is too off from some of the guidance values, then either it is something that has happened in a really short period of time, in which case we drill deeper, and before we make a deal or before we throw out an asset, we look at what are actually the parameters that go in, and that's where we are 98%. We compensate for that 2% with this manual involvement, right? But essentially, coming back to the question, two pieces: market data from all over the internet, all of the classifieds websites and whatnot, and guidance values from government websites.
Okay, great. So let me take a couple of more questions and then we can end the session. I'm just looking for a question that's really good. Okay. One really good question that you have, I think, Nimit, you can answer this, right? So what proof do investors get on their investments? I think this question will help a lot of people.
Okay, so investors, when they invest in a SPV, they get CCDs, okay, compulsory convertible debentures. Each CCD is 100 rupees. So suppose you invest 10,000 rupees, you'll get 100 CCDs. So when you invest, within 7 days, the asset is fully funded. You will receive a certificate of CCD under Companies Act in your login. So yeah, you'll ideally get CCDs. And so this question sometimes get asked whether these CCDs are in DMAT form or not. So these CCDs are not in DMAT form, but they are issued under Companies Act. So they are equally legal under law.
Perfect. Thank you, Nimit. We have another very good question as well. So this question is again from Azim. He wants to know, are you going to stick to this particular product offering, or will you diversify, etc.? Srinath, can you take this one?
Okay, sure. I feel like I spoke about that in our future or what we want to do. But let me just talk about like what is Aasthy's vision, right? While I've put in a high-level way, democratizing real estate investments, our aim is to have 30% of the portfolio, 30% of an investor's portfolio go into real estate, right? Today, that's not happening. With whatever existing infrastructure that is there with REITs and all of that, it's still not 30% because either due to low returns, lack of data, all of those things, right? So just keeping that aim and vision in mind, of course, we will try and diversify, right? Now, when we look at real estate itself, it is a pretty large asset class. Right? There are so many options within it. So we obviously speak about housing, then you have commercial, then you have even more broader infrastructure projects, right? Like roads, highways, like solar plants, etc. Right now, these actually end up having even higher return on investment. However, the participation is very different. Right, it is not as accessible as let's say what we do with housing. Commercial becomes a little less accessible, and then you have these large infrastructure projects. So not for the next few months, but definitely, I mean, as all of you users keep distributing your portfolio, hold on to it, and we will definitely have more options very soon.
Okay. So I think we have almost come to the end of this webinar. I'll just take one last question and then we can end this session. I think again, Srinath, I'll have to come back to you on this question again. So this one is from Radha from the chat. She wants to know, we always see often in India news headlines about the failure of real estate builders to meet deadlines or has turned bankrupt or have got involved in legal entanglements. So with this background, how do you ensure return or redemption of our fractional investments?
Got it. So Nimit answered quite a bit of this, but I'll just again probably give a different flavor of this, right? So on one side, we do know that a lot of other players who have done fractional investments have always gone in at the early stage of any sort of development, right? Looking for a much bigger capital appreciation, right? And that is essentially that risk versus reward that even Nimit spoke about, right? And there, obviously, the expectations are very high. And when there is high returns, of course, there is a lot of options for delay. However, because we are going in that sort of 90-95% completion stage, the risk is significantly minimized, right? And post that, we have these, what do you say, our price prediction algorithms, which are effectively telling us what is a price at which we can liquidate the asset ourselves if we need to. And all of these, buyback agreements that we get into in today's world, like we may not be doing this for the longest period of time, but with all of these, we always get into those at a lower rate compared to the market rates. So in case, any of these things happen, we are ready to go out and liquidate these assets. These assets are already being sold to the end user, and we can always go out and liquidate this ourselves at a price higher than what the buyback guarantee is. So that's how we ensure, we are able to get these things done.
Perfect. Thank you so much. Thank you, Srinath. Thank you, Nimit, for answering all these questions and giving all your insights into Aasthy. And I'm very sure that this will not be the last webinar. We'll have a lot more webinars coming in. This is something that we've decided to do on a regular basis, and we hope that we continue doing this. At least we plan to do at least 3 to 4 webinars on a monthly basis, but I hope we stick to that. Right? So thank you to all the participants for joining us today. We've already exceeded our 45 minutes time limit by 5 minutes now. So I think it's better to end this webinar right now, but this is being recorded as we speak, and we will put this up online and we'll share the link across to all of you guys. Thank you so much.
Thank you everyone.
Thank you, everyone. Thanks, Roshan.